If you only have 15 minutes in the morning, this is exactly what I would do with them. For years, I believed I needed hours in front of the charts to be profitable. It turns out to be it's the opposite. After 8 years of trading liquidity, I found the levels that can cut your screen time by 90%. So in this video, I'm gonna give you a step-by-step tutorial on mechanical liquidity zones, how to find them and exactly how to trade them. And it doesn't matter what kind of trader you are. Let's get started. Let me prove something to you in about 30 seconds. And once you see it, you will understand why trading is taking up your whole day. Same chart, two traders, two totally different sets of levels. And both of them would swear theirs is right. I tested equal highs and lows, trend lines, every type of liquidity level people teach. And here's what I found. They are all subjective. Two people with the exact same knowledge will mark two different charts. There is no single mechanical way to do it. And here's the part nobody connects. Every subjective level is a decision. Is that swing high significant enough? Do those two highs count as equal? Should this trend line touch the wicks or the bodies of these candles? That's 10 decisions before you've even taken a trade. And decisions are exactly what keeps you glued to the screen for hours, second-guessing yourself. So here's a simple test for any level you draw. Could a complete stranger, given your rules, mark the exact same line on the exact same chart? If the answer is no, it is subjective, and it's costing both consistency in your morning. So what would a level that is not subjective even look like in real life? This is one idea that fixes all of it, and it's almost stupidly simple. Everything on a chart is up for debate. Where the zone starts, which high counts, how to draw the line, except for one single thing: time. 1 a.m. GMT is 1 a.m. GMT for you, for me, and for a hedge fund in Singapore. Yesterday's high is yesterday's high. This is exactly one answer, and nobody on earth can argue with it. So to make liquidity levels subjective, you stop defining them by the price patterns and start defining them by time. The levels that are tied up to the time and that hold genuine liquidity are these: previous session high and low, previous day high and low, previous week high and low, previous month's high and low. That's it. Those are the real key liquidity levels, and they are absolute. Watch this. These are exactly one way to draw these. No judgment, no opinion, no does this swing count. It's just where it is. 30 seconds and I'm done. And here's why these specifically matter. Not just that they're easy to find. Think about who else can see yesterday's high. Everyone. Every trader watching the market. Every algo. Every fund. It's the most obvious level on the chart. So what happens above it? The stop losses pile up, breakout orders pile up, all that pending business clusters right above and below those obvious levels. And that's the whole point. Obvious means crowded. And crowded means liquidity. These are not good levels despite being obvious. They're good levels because they are obvious. That's the opposite of what most gurus tell you, and it is why this works. So, 4 types of levels. Which ones are actually yours? Using the wrong one is why the right level still won't work for you. A swing trader making sessions highs is just trading the noise. A scalper waiting on a monthly highs will sit on his hands for a month. The level has to match your time frame and your life. So here's the rule. First, decide what kind of trader you are. Then your liquidity levels and your chart are all already decided for you. If you want to become a scalper, the session highs and lows on the 3-minute chart is way to go. If you want to become a day trader, daily high and low on the 15-minute chart is the time frame and the levels that you have to trade. If you want to become a swing trader, weekly high low on the 4-hourly chart is yours. And if you've got a job in 15 to 30 minutes in the morning, you're a day trader, full stop. So your entire liquidity map is the previous day highs and the previous day's lows, marked on the 15-minute chart. 2 lines, that's the whole thing. This took me 20 minutes and told me nothing. This took me 30 seconds and tells me everything. 2 lines on your chart, So what actually happens when the price gets there? Once you see this, you're going to understand why you keep getting stopped out right before the price finally goes your way. And I promise it's not a bad luck. You've lived this. You take a good trade, price wicks just far enough to take you out, and then immediately runs in your original direction without you. Every trader thinks the market is personally haunting them. It kind of is, just not the way you think. Big players have a problem. They need to fill enormous orders and there is not enough resting liquidity to do it quietly. So they need a pool of orders to trade against. Where's the biggest, most predictable pool? Right above yesterday's highs and right below yesterday's low. Because that's where every retail stop loss on earth is sitting. So price gets pushed through the obvious level. All those stops trigger. That flood of orders is exactly the liquidity the big player needed to fill their positions. And then with the order filled, price reverses. You were not unlucky. You were the liquidity. Here's where retail got stopped out. Here's where the big orders get filled. And here's a reversal that leaves everyone behind. And here's a beautiful part. This happens on a schedule. You've probably heard of the Asian consolidation, London manipulation, New York reversal. Most people treat that as a vague theory. We made it 100% mechanical. All you need to do is to mark up the first 4 hours of the Asian session from 1 a.m. to 5 a.m. GMT time, the London time. That's not opinion, that's a clock. During those 4 hours, the market is quietly building up liquidity. The London opens, the volume floods in, and the manipulation happens. The sweep of that range, the one thing that you need to be able to tell apart, a sweep versus a real breakout. A sweep is fast. It wicks through the levels and it closes right back inside. It grabbed the stops and left. A real breakout closes beyond the level and holds there. Sweeps equals to reversal trade and the breakout that holds equals to no trade for us. So now you know where the levels are and what happens when price arrives. Let me show you the actual routine. Real quick, if you want me to look at your actual charts and walk you through levels and your sweeps with you personally, that's what we do inside the mentorship. Having someone review my setups with me was genuinely the thing that turned my trading around. The link in the description below. Now, the routine. So here's exactly what I do every single morning. I'm going to give you the exact time each step actually takes. So you can see for yourself where the 15-minute goes. Open your 15-minute chart, mark the 3 things: the previous day high, previous day low, and the first 4 hours of the Asian session from 1 a.m. to 5 a.m. GMT as the box. That's it. And notice what you didn't do. You did not analyze anything. You did not decide anything. You marked what was objectively there. That's why it takes just 2 minutes instead of an hour. One quick look. Is the bigger picture bullish, bearish, or ranging? You're not doing deep analysis here. You just want to know which way the wind is blowing, because it changes what a sweep means. So here's a caveat, and it matters. A sweep of the previous day's low inside a bullish context is a high quality long. The exact same sweep inside a hard downtrend is probably just a continuation to the downside. The market is just going lower and it's not coming back for you. Same level, same sweep, completely different trade. So the context decides whether you take it. So set a price alert on your levels, then close the laptop. This is a step that gives you your life back. And it's the one nobody does. You don't need discipline or patience to avoid overtrading. You need not to be sitting in front of the charts. Remove yourself and the temptation disappears with you. The moves that matter happens around the London and New York opens. That's when the volume arrives and the manipulation happens. So you show up then, not all day. If nothing sets up in that window, there's no trade today. And that's completely normal outcome. So you're waiting for one thing: the manipulation of your range during the London or New York session. Price sweeps one side of one of your levels, takes the stops and reverses back inside. For the entry, I'm looking for that sweep and reversal. Then I drop a Fibonacci on the reversal leg and enter on the golden zone, the 60 to 80% pullback. Stop goes just beyond the wick of that sweep. Because if the price genuinely reclaims that levels, my idea was wrong and I want out cheap. Target a minimum of 3 to 5 R. One note from my own testing: if there are 2 sweeps, I take the second manipulation of the range, because that's the one happening during the London session rather than before it. Okay guys, let's break down a couple of real life examples on the real charts. Fixed 1% risk, stop and target set before you click. One setup per session, then you're done. Close it and go to work. Okay, let's focus. Okay folks, let's break down how you can actually use all of this information in the real market conditions to take high quality trades. First of all, I want to break down all of the traders into 3 categories. You are either scalper, day trader, or you are a swing trader. Based on the type of trader you are, you have to choose the time frame. For the scalpers, it is going to be 1 minute time frame to 3 minute time frame. Anything between that, like you can choose 1 minute or 3 minute. For the day traders, that is going to be exactly 15 minute time frame. And for the swing traders, that is going to be 4 hourly time frame. And this is, guys, very important, and you will understand why. So basically, based on the type of trader you are, you have to choose your time frame. For example, let's start with the highest one, with the swing trader. You go to the 4 hourly time frame, and you have to identify the previous week and previous week high and previous week low. For that, I'm just using the cyclical lines. All of this area, as you can see over here, inside of these 2 vertical lines, is the whole week. All you need is to draw the lines. Here is the lowest point, here is the highest point, and as you can see over here, at the beginning of the week, the price swept the previous week high and then reversed to the downside. The same applies here. For example, this is going to be the previous week low, this is going to be the previous week high, and as you can see over here, the price swept the previous week low and then reversed to the upside. So basically, this is the point where the price is going to reverse. Or if we do have the strong breakout, we can continue in the direction of that breakout. So this is what comes to the swing traders. You have to look at previous week high and previous week low. Then let's go to the 15-minute time frame, which is day traders. Let me delete this one. So the same logic applies here. This area between 2 lines is considered to be the one whole day. And the logic is simple. This is, let's say, previous day high, this is previous day low, and all of the liquidity, all of the key reversals are going to be inside of these levels. So the first thing that we have to pay attention as a trader, as a day trader, is the previous week high, previous day high and previous day low. And let's move to this to the scalping. And for the scalping, I want to break down our own strategy, which is called OP method number 3. All we have to do is to mark up the high and the low of the price action of Asian session, but not the whole Asian session, but only the first 4 hours of the Asian session. For that, I use this indicator, which is called sessions, and the settings you can see over here. So this vertical gray stripe represents the first 4 hours of the Tokyo session, Asian session. So we draw the high and the low, and we want to trade the manipulation around this Asian range. It doesn't happen every day, but when it works, it is one of the best ways. And I have prepared 10 examples from the past how this worked out. Let's break down all of them one by one. Okay, folks, let's now talk about the liquidity for scalpers. For that, we need to identify the first 4 hours of the Tokyo session. We are not going to use the whole session. We're just going to use the first 4 hours. And guys, to make it like simpler, I do have this indicator, which is called sessions, and the settings you can see over here. So basically, this vertical gray stripes represents the Asian session, the first 4 hours. We don't need the whole. All we need with this strategy is to mark up the high and the low of the price action during those 4 hours. This is going to be our reference point for trading the liquidity. And with this strategy, we will be trading the reversal from the Asian high and Asian low. Now let me break down like simply how it works, and then we can jump into the real life examples. For example, this is our Asian high, this is our Asian low, let's say. And then we want two things. First, we want the manipulation of the Asian high or Asian low, it doesn't matter. Then we want the manipulation, and we don't trade the first manipulation. We wait for the second manipulation. And on the second manipulation, we are going to enter our trades. And as you remember, like I've told you that you have to trade for the scalping, you have to go into the 1 minute or 3 minute time frame. This is exactly what we are going to do with this case. By the way, guys, this is OP method number 3. So on the lower time frame, you are going to see something like, let's say this is Asian low. You are going to see something like this one. The whole new structure. There's going to be the breakout structure over here. It was the downtrend. We made the change of character to the upside, and then we are entering with just fib levels. You can use the fib levels for your entries. This is the first method of entry. There is the second method of entry, where the price is not going to give us the confirmation on the low time frame, but it is going to look like something like this. So basically, the price just fell to the downside and it went up. Even on the low time frame, there is going to be no structure, no market structure where you can look for the change of character. So it is just going to be the manipulation, and then it is going to be the build up of the new order flow. In this case, we are just going to draw our fib levels from this low to this high and enter on the golden zone from 60 to 80% tracing level as the stop loss goes beyond 100% level, and we will be aiming for 3 to 5 hour. Sometimes the price is going to give us more, and we will basically break it down in the real life examples right now. So guys, yes, we need double manipulation, and we jump into the low time frame, look for the change of character or the buildup of the new order flow based on the context of the markets. So guys, let's break down a couple of real life examples, but unfortunately they are going to be just on the 15-minute time frame. As you can see over here, this is our Asian high, this is our Asian low. The price is going to the upside, manipulating the Asian high, and then it is breaking to the downside, manipulating the Asian low. And over here, as you can see, we don't have any structure. The price is pushing up, we're drawing our fib levels, and it's retesting the 80% tracing level and going to the upside, giving us a beautiful 5-hour trade. Let's break down another example. Let's say this one. As you can see over here, this is our Asian high, this is our Asian low. This is happening on the 15-minute time frame. We're having the manipulation of the Asian high. Then during the New York session, the price is falling to the downside, manipulating the Asian low. And if you drop to the 1-minute time frame, you're going to see a change of character over here, and we're entering with a change of character at the 80% retracement level and aiming for over 10-hour trade. Guys, this is crazy. Another example over here, this is our Asian high, this is our Asian low. The price is manipulating the Asian low, and then we are having a very strong impulse to the upside without any market structure on the low time frame, as you can see over here. And then we are entering just on the beginning of the new order flow to the downside. And even with this case, guys, the price is giving us more than 5-hour trade. We do have another example over here. As you can see, the price is manipulating the Asian low and reversing to the upside. In this case, kind of like the price gave us the opportunity to trade the OP method number 3, both from the bottom to the upside and from the upside to the downside. As you can see over here, it manipulated the beginning of the new order flow to the upside. And then on the second manipulation, we do have the same. We do have just an impulse to the upside. Like even if you go to the low time frame, there's going to be not much of the market structure. The price pulled down, went up. Like again, like over here, you could have entered at the 80% and got another 5-hour to the downside. Here we do have another example of OP method number 3. The price is giving us a beautiful 10-hour trade. But in this case, yeah, we are having one side of manipulation. That's not the best case, but it is still valid. Over here, we do have the Asian high, the Asian low, the price manipulated the Asian high, and then we do have the manipulation of the Asian low over here. Entry with the fib levels at the 60%, the stop loss goes beyond 80%, and we're getting a beautiful 5-hour trade. Another example over here, the Asian high manipulated, Asian low manipulated, entry at the 80% and beautiful 10-hour trade. Another example here, we do have the manipulation of the Asian high, then manipulation of the Asian low, and then the price is giving us over 10-hour trade. Another example here, the Asian high manipulated, Asian low then manipulated, entry with the fib levels, and the price is giving us like 20-hour trade. Over here, another example, guys. The Asian low gets manipulated first, then the Asian high gets manipulated, entry with the fib levels, and the price is giving us over a 5-hour trade. Guys, aiming for 5-hour with OP method number 3 is the sweet spot. But if you're asking what the hell we are trading other days when the OP method number 3 is not working, I will talk more about that later in this video. Just make sure to stick till the end of this video. So that's the whole thing. Your levels were never the problem. The subjectivity was. Every level you had to decide on was a decision that cost you time and consistency. Tie your levels to the time instead, and they become absolute. Previous day's highs, previous day's lows, and the first 4 hours of the Asia. 2 lines in the box, 30 seconds to mark. Then you show up for the London and New York to open. You wait for the sweep, you take one entry, one trade with a fixed risk, and you close the charts. That's a 15 minutes a day. Not because you're cutting corners, but because there are genuinely nothing left to decide. Now, if you want a complete rule-based system I run on top of these levels, the exact entry rules, the sessions, the full breakdown, I put together a free training that covers all of it step by step. It's a first link in the description, and it's the next one thing that you should watch. You never needed more hours. You needed levels that you didn't have to think about. I'll see you inside.